and do that. Hello and welcome to the Fat Tailed Thoughts podcast. My name's Stephen Dickens. I'm your co-host as always. And we cover here on the Fat Tailed Talk podcast the workings and makings of money, fintech, and crypto. I'm joined as always by my co-host, Jared Klee. Hey, Jared. Welcome to the
Hey,
show.
Stephen. How are you?
Yeah, good. It's Monday morning, so a different vibe to a Friday, but yeah, feeling good. How about you?
Good. It's a
So
fun
this
one.
week,
We get to go in. We get to go a little deeper on startup equity again.
your favorite topic. We keep going back to this well, but no, I think there's still a lot here. We're on to episode 21, which, as always, makes me frankly amazed that we've done this now for 21 weeks. But hey, we are where we are. So we're back to startup equity. Just for the listeners, this is part 0 of what has now become a 4-part segment of our show. Highly recommend you go out and check out episodes 1, 2, and 3 in the series. But we felt there was a need to go back almost to first principles because we'd kind of jumped in. So if you're sort of listening out a sequence, maybe start here and then go and check those previous episodes out. We'll
Yeah. So
call
this
this sort of
was.
episode 0 in the series.
Yeah. This was the letter that kicked all of this off. So I originally authored this back in August, and then actually all the letters that have come out since then have been subsequent conversations where folks really appreciated and got into some of the topics we're going to talk about: how to think about equity, how it can be structured, the different tax treatments. There's a lot of nuance here that triggered a whole series of conversations that led to the follow-ons on, okay, secondary markets and how do I exercise my options and all that kind of funness.
But I think it's worthwhile going back to almost, as we say, first principles, go back to the very beginning, because we kind of jump straight in and assume some things. I think for the listeners here, we're gonna sort of really go through 2 pieces. The first piece is how to think about how to think about equity and what that means. And the second part of the show is some of the different structures and how you are going to get awarded that equity. So let's dive straight in here, Jared. How should the listeners be thinking about this equity? Let's start and spend the first maybe 10 or so minutes on that topic.
It's the right place to start because it's the all the other conversations we've had and topics we've covered assumes that you own equity. And now we're going back to the beginning of saying, hey, I'm thinking about taking a job or I'm at a startup right now. And well, you could get equity. Well, the question is, what is that? What does it actually mean? And the immediate place to start is, and it's a bit of an overstatement, but it's a good framing. It's a lottery ticket. So at the end of the day, you could, if you're thinking about joining a startup, you could go join a big company that's more established. It's going to be safer, meaning it's less likely to go bankrupt. It's probably going to generate revenue year over year. That revenue hopefully will grow at some reasonable rate, and you're going to get paid a nice salary for joining there. In expectation, you may get some equity, but that equity is, if it's a public company, you're not going to get a lot of it, and it's going to grow at a reasonable rate. By contrast, at a startup, startups give out equity. It's basically, you can think about it almost like a loan, and I'll explain what I mean by that. But they don't have a lot of cash. All that cash needs to get plowed back into growth. So they give you a lower salary on average. And in return, they give you these lottery tickets that, hey, if we make it big, if we were really successful as a startup, your equity is going to be worth a lot. And the reason I phrase it as a lottery ticket is, and we see kind of different numbers over the years, but CB Insights 2-3 years ago put together, they took a sample of 1,000 seed funded startups. The number of startups that made it past seed to Series A, 48%. By the time you get down to a 6th round of funding, 3% of the companies are still alive, meaning they either got funded, went public, or got acquired.
I think this is the distinction. We on previous shows we've talked about the average startup now is 12 years before it goes public. That 12 years doesn't all look the same. There's a very different type of organization that is maybe pre-Series A Then there's Series A, B, and C, maybe. Then there's D, E, and eventual exit. Maybe there's different time slices within that 12 years, and
But
maybe
even
that's a nuance we should talk about here
it
as
is,
well.
but even the fall off between these is frankly pretty shocking when you look at the numbers. So if, again, just taking CB Insights 1,000 seed funded startup sample, there was just under 50% made it from seed round into, never mind how many didn't make it to seed. Just under 50% made it from seed to Series A. Just over 50% then made it to Series B. Exactly 50% made it to Series C. I mean, we're talking significant fall offs at each point, and inevitably, if you get rid of half the group every single time, well, it's time you get to round 5, round 6. There just aren't that many companies left. So the odds are slightly better than the lottery. But the right way to start thinking about equity, and we'll go through the much more nuanced conversation, is it's a lottery ticket. More likely than not, it's worth 0, but there's a small chance it's worth a huge amount.
And that chance, going back to what you were saying, changes materially of whether you're joining us a pre-Series A startup, whether you're joining a Series C startup or a Series G startup. Thinking about the chance of your lottery ticket paying out is materially different at just those 3 points that I mentioned, let alone the points in between.
Bingo. So that's so if I were going to kind of 4 things, if I'm joining a startup that I'm going to think about, one of them is timing. And that timing is, where is that company in terms of its maturity? So that'll help gauge on the riskiness factor. But 2, it's also going to matter how long do I think they're going to stay private versus public. Now, we talked in the other podcasts about, okay, we're starting to get liquidity for private startups, but realistically, your best access to liquidity is when a company goes public. And if you think the company's 2 years away versus 10 years away, well, you should go in with the assumption, if it's 10 years away, that you're not going to, that equity is going to look great on paper, but it's not going to be cash.
And I think the biggest thing that's come out of this arc of the episodes for me is that fact. I think if we were to do a poll of how long do you think a startup is before it goes to an IPO, I think people would naturally tend to gravitate to 5 to 7 years, and they'd be very wrong.
They'd be off by about half.
Yeah. So I think that's been the biggest revelation. I mean, we've covered lots of points. This has been a great sort of arc of the episodes. But I think time frame in investing, time frame in anything, if 12 years versus 6 years is a materially different period of time when you're planning your life, when you're planning when you need cash, I think that's been the biggest takeaway for me of how long it takes for these companies to go public.
Yep. So we hit on 2. You've got timing, which is kind of what's the time to actually take ownership of the equity for it to go public. The second is liquidity. What's your ability to get access to cash, say, before the IPO? The 2 other big ones, structure, and we're going to spend a lot of time on this. You have RSAs, you have RSUs, you have ISOs, you have NSOs. There's this alphabet soup of different ways startup employee equity can be structured. This isn't just like, okay, whatever. It makes a huge difference in terms of how much you actually take home and what it means to actually own equity. The last is cost, and that's in kind of tied up in the structure conversation. Things like options, you don't actually own the equity. What you own is the right to buy the equity at a predetermined price. Well, that means you got to shell out cash to get access to it. We're going to get into that. These different structures, then you start talking about taxes. They have different costs associated with them. There is one more that we're going to gloss over, but it's important to keep in the back of the mind. It's the 5th topic, and that's share class. And the reason I say we're going to gloss over it, most startup employees and founders get what's called common equity. Common equity is the bottom of the barrel, bottom of the stack. The Funders, typically venture capitalists, will get preferred equity. And it's exactly what it sounds like. It is preferred to the common equity. Now, you can have multiple layers of preferreds. And typically, as the Series A funders will be, the Series A funders will be subordinate to the Series B, will be subordinate to the Series C. They'll be less preferred. It stacks over time. But the types of things that get buried in here, there's preferred is a general term. You can kind of bury whatever you want in there. But typical things are, I'm entitled as the Series B funder to a 2x return on my investment before anyone else gets paid. So what that means is that if you're funding the company at a 50 million valuation, if the company sells or IPOs for anything less than 100, nobody else gets paid. But if you break through 100, they're now even with everybody else. These are really, really important distinctions, because even though you may see the valuation of the company go up and up and up and up and over time, depending on the terms in the preferred equity that sits ahead of you in the food line, even though the company may have an IPO, may look successful from the outside, you as the owner of common equity as employee may still take home nothing.
So you've got no control and ownership. You've got no control in that equation.
That's exactly right. So I'm putting that to the side because everything else are kind of levers that most startups will manage. You get RSAs or options or so on. These are kind of real considerations, but you have to know going in as an employee, for most startups, you're getting common, the investors are getting preferred. They're better off than you in almost every situation, except for the one where the company does phenomenally well, in which case you tend to generally all share equally in the upside.
So let's get into some of those structures. We're sort of halfway in here. So let's talk about RSUs, RSAs. There's a good breakdown in the newsletter of those, but let's spend some time just sort of going through each one of the 3 or 4 sort of different varieties here of equity awards, basically.
So we're going to kind of talk about these in order of how big the company is. So what do I mean by that? The biggest challenge with awarding employees equity is that the equity has value immediately. If the company's worth $100 million and you give somebody 1%, that's $1 million of equity. And well, Stephen, if I handed you $1 million today, well, first off, congrats. But secondly, the first problem you would have is you would owe taxes on that. And the question is, if I hand you $1 million worth of stuff, but it's not cash, you got to go find cash in order to pay the tax ban. Well, startup employees, that's exactly the problem, is that the startup's trying to give them equity and the expectation will grow over time, but it has value today. So they have to find ways of structuring it that are tax advantage, that don't burden the startup employees with these massive tax bills. So what happens is, as the equity gets more valuable, you tend to change structures. Meaning you go from a structure that's that's okay, it's not worth that much, so we don't care about the taxes, to ones where we can kind of put it off so you're not hit with the tax bill.
Well, the other big dynamic here is, and we'll talk about this $1 million you're giving me. Thank you for that, Jared. Depends on who I am and what $1 million means to me from my behaviors. If your $1 million is a material amount of money and it's going to change your life and change how you think about the world, well, that might not align with what the company wants to get from me and the amount of work it wants me to put in. But if they can scale that $1 million and have it vest over a period of time, keep me engaged so that I keep investing the 14, 16-hour days to grow the startup, that's another dynamic here. So maybe that's a segue into kind of what vesting is. Typically, you're not going to give me that $1 million on day one without any period of time attached to it or any sort of terms and conditions attached to it.
So actually, really, really good intro. So we'll start with basic structure here. So vesting, typically, if you're signing up, a traditional vesting schedules, you'll hear the term 4-year vesting with 1-year cliff. What that means is vesting means you earn it over time. So even though I'm promising you it in an employment contract today, you don't actually get it. After a year, you get 25%. After 2 years, you get 50%. After 3 years, 75%. So you earn it over time. That ensures that somebody doesn't show up on one day, get a bunch of equity, and just leave. They get it over time. The cliff means that the vesting accrues, but you're not entitled to it until the cliff. So typically vesting will happen on a monthly basis. But if you leave before a year, you get 0. If you leave it a year and a day, you get your full 25%, and then it will accrue monthly thereafter for the remaining amount.
So we'll stay on the $1 million that I'm getting. I don't get my $1 million on day one because you don't want me to leave on day 2. You want me to hang around for at least a year, and then you'll give me a quarter of the $1 million, and then I'll get the remaining 3/4 of the $1 million over the subsequent next 3 years
on a monthly basis.
And this goes back to the aligning what you want from me as an employee. You want me to hang around for 4 years, work my tail off in return because I'm investing in the 4-year growth trajectory of the company. And in return for me working my tail off for the next 4 years, you're going to give me that $1 million worth of equity and have it lay out over the term that we just talked about.
So an important distinction here, and this comes back to structure, and we're going to start going through kind of like early stage, later stage, is that vesting schedule, even though you earn it, even though you own it, it can actually, what you actually own and whether or not it can be taken back from you changes materially. So early stage startup, not as valuable. Taxes are not as big a concern. Typically, employees are going to be awarded what's called RSAs. It's restricted stock awards. Now, restricted stock awards are actually stock. It is the actual company equity. You own it legally at grant. You owe taxes, ordinary income taxes, as it vests. So what that means is it's awarded to you today. So from a legal standpoint, yes, it's yours, the full 4 years of whatever. But after a 1-year cliff, you now owe taxes on the current value of 25% of it. Then you owe taxes on the remaining amounts. There is a way of paying the taxes in advance. You can do what's called an early purchase. So what the tax man allows you to do, what the IRS allows you to do, is they say, hey, look, you can purchase all 4 years that are going to vest today. For tax purposes, we'll treat it as if you got all of it today, even though if you leave after 2 years, you give up the latter 2 years. Now, why would anyone do that? Well, if the company's getting more and more valuable over time, and you're paying taxes on the then current value, well, if you 10x the value of the company between the time you start and year 2, you're paying 10x the taxes too. But by accelerating that tax burden to day 0, you pay it when the company's still not worth that much. Now, flip side, and you just got to do the math for yourself, is that if you leave after 2 years, well, you paid taxes on 2 years of equity that you're not getting. If the company goes bankrupt, you paid taxes on a whole bunch of equity that's now at 0. So it's a trade-off. But generally speaking, because the equity is valued so low at the start, it can be you can pay $20, $50 in taxes. Got it. I've paid the tax burden for the whole 4 years.
So say the company's valued at 10 million when you get given those RSAs, and then the company goes on to be worth, as you say, 10x 100 million. You're given, I don't know, 1% of 10 million versus 1% of 100 million. That could be a material amount of different
and typically RSAs are going to hit when the company's worth $500,000, $1 million. I mean, we're talking pre-seed, et cetera, where again, your total equity, it's just, you're not paying taxes on a huge amount.
Mm-hmm.
So the tax burden here, you pay taxes at vesting unless you do what's called an early purchase. You accelerate that tax burden. The taxes you pay then are ordinary income tax. When the company eventually, if you then hold it for at least a year, it's long-term capital gains when you eventually sell. So that's nice. Capital gains typically right now it's around 20% Ordinary income is going to be 30, 35, and plus local taxes.
Also, if you've got the opportunity to get RSAs in an early stage startup, pretty good thing to be given access to.
Yeah.
If you think
also importantly, RSAs are 83B eligible. 83B is a part of the tax code created in the Small Business Act. It allows you to avoid capital gains taxes, your long-term capital gains, up to $10 million of capital gains. Hugely attractive. The requirement is at the time you receive that equity, you take ownership, the company has to be worth less than $50 million. So RSAs are nice because, again, from a legal standpoint, you've taken ownership of them the moment they're given to you before they vest, so they qualify for that 83B.
Mm-hmm.
Then you can accelerate the tax burden as well. So that once the company gets a little more valuable, that model doesn't work because if we take the $10 million startup and you get 10% of it, $1 million, you're not paying taxes on $1 million bucks of equity, especially if you're a startup employee. You probably don't have the cash to do so. So the startup, rather than giving out RSAs, is going to switch over to options. Now, to be clear, RSAs, restricted stock awards, is actual equity. You own the stock. Options is the right to purchase the stock. You do not own equity. You own the right to purchase equity. And this is a critical difference because if you own equity, it cannot be taken away from you. It's yours. If you own the right to purchase, that right can be taken away from you. It can expire. And this is one of the biggest challenges with options, especially as startups stay private longer. Legally, the longest you can create an option contract is 10 years minus a day. So if it takes 12 years to go public, your options contract, if you joined on day 2, will expire before the company goes public. Now, the startup's going to try and help you out. They're going to do a whole bunch of fun stuff, but they cannot extend that contract to give you that right. You'll also see typically 3 months after departing a startup, if you leave the startup, your options contract will expire. So even though it's 10 years on paper, it's only 10 years if you stick around the company. It's 3 months if you leave.
So you've got 3 months to exercise your option to buy the stock at the price that you've agreed that you can buy the stock at, but you've got to exercise that within 3 months.
Bingo. So there are So 2 different types of options here. In this, by the way, U.S. specific, we have ISOs, which are called incentive stock options. We have NSOs, which are non-qualified stock options. The difference here, ISOs only allowed to be issued to employees. ISOs are tax exempt at exercise, meaning if I get to buy a $10 share and I pay a dollar per share, I do not pay taxes on those, on that $9 difference per share. For an NSO, I would pay taxes on that $9 difference per share. NSOs can be given out to anyone, to advisors, to board members, to whomever. ISOs, you can only earn up to $100,000 a year in ISOs. So once your gain exceeds $100,000, any additional options that vest that year automatically convert into NSOs. Now, what does that actually mean? Well, if I'm given, again, what's $200,000 of equity, of options that will vest over 4 years, let's call it $50,000 a year. If the company triples, quadruples, 10x's in value, well, the amount that's vesting year over year is now $200,000, $500,000, maybe $1 million in equity a year. The first $100,000 of that will be tax exempt. The remaining $900,000 or whatever it is, I will pay taxes on when I exercise the option. What that means, again, as a startup employee, is it's not just the cash to take ownership of the equity, to exercise the option. It's now the taxes to pay off the tax man for that $900,000 gain. That becomes really painful really quickly.
So let's try and work through an example here. you've got the option to buy a million's worth of equity for 100K because you got locked in at the 100K's worth of stock price. You've not only got to get the 100K to buy the stock. That sounds relatively straightforward. You've got 900K's worth of appreciation that you've got to pay the tax on. So you've got to find 100K plus the taxes on the 900K in that equation.
And you will owe ordinary income taxes on that 900, the 35%. You don't get the long term, you pay ordinary. That's a
so
lot.
You could
That's
be
another
30% of 900 plus having to find 100 to get a million's worth of equity.
Exactly. So what's rough numbers here? You're showing out 400 grand to take ownership of $1 million of equity.
So you're still up 600, but it's
assuming
not,
you could get access to the cash.
You're not up at 900 that you might think you are. Right. You're up you're up 600 in this simple worked equation. So it's still good. It's just less good than you think it is if you don't factor in the tax.
And all those other considerations, which is that if you leave the company within 3 months, that your options go away. By the way, legally, if your startup does extend that timeline, let's say you have a year or 2 years or 5 years to exercise the options after leaving, legally, all ISOs switch over to NSOs after 90 days. So you're automatically you're going to
so you're losing that first 100K's worth of,
again, because ISOs only allowed for employees. So the tax man
not an employee any longer. So therefore, you lose the entitlement benefit of being an employee.
So there are some other considerations, like with the RSAs, you can early exercise options. What that means is you pay to take ownership of the equity before it vests. It's the same trade-off we talked about with the RSAs, meaning if I early exercise the options, I take the tax hit immediately, but if there is a tax hit, I pay the option exercise price immediately. But if then I leave, if the options don't vest, if the value goes to zero, I've already paid those taxes. I don't get any of that money back. But what it will do is, if it costs $100,000 to exercise the options, let's just say they're at the money, so $100,000 to get $100,000 of equity, I will pay the exercise price of $100,000. I will pay no taxes because there's no gain to pay taxes on. And then at that point, as the options vest, I've already exercised them. I take ownership of the equity. And even though it may go up to $1 million in value, I pay no additional taxes until I eventually sell the equity. So again, I've accelerated that tax hit immediately.
So a lot to think about here. Again, timing, where you are in the equation, what the price is, where you are in this 12-year on average cycle that we talked about, your ability to raise cash to buy those options. Lots of things to think about from an individual point of view, and also do the tax planning. And we're not trying to come across here on this podcast as tax planners. What we're saying, and Jared's very clear about this in the newsletter, is go take some professional advice. We're trying to identify some big rocks. Yeah, this is some big rocks in the road. How to navigate around those rocks, you need professional advice for.
So many startups will, it won't help with the tax burden, but it will help with the exercise. So again, if you don't have $100,000 to exercise those options, many startups will allow you to, slightly different term, but we'll call it cashless exercise. What it means is that if I own $100,000 worth of options, I can sell $50,000 worth back to the company, and they will take the cash that they would have given me for that to pay to exercise the other options. What that means is no cash changes hands, but I'm able to take ownership of the options. The problem with that is, again, that tax burden. Yeah, I'm still going to have to shell that out myself. Now, this, just to make the math a little more complicated on the options, I want to, from a tax burden standpoint, I want to exercise the options as quickly as possible. because the valuation hasn't gone up. So the gain is close to zero, or at least as small as it will ever be. So the tax burden is as small as it will ever be. The flip side is, if I'm trying to do a cashless exercise, I want the option value to increase a lot. So the thing I'm selling back to the company is more valuable. So I have to sell them fewer options in order to pay for the other ones. So there's this inherent tension where if I'm trying to do a cashless exercise, I want to wait, but then my tax burden goes up. But if I do a cashless exercise now, my tax burden is low, but I got to sell a lot of options back to the company to pay for it.
And the other dynamic is, whilst the company wants to look after you as an employee, they're also they're a commercial enterprise, and this may not be structured in 100% the most positive way that it could be for an employee. So you've got to, the net is here, lots of moving parts in an equation that you've got to factor out for yourself about where you are in your life, where you are with money, where you are with thinking through how long you're going to be at this company, where you're thinking this company is going to get towards a liquidity event. Yeah. None of what we're saying here, listeners, is this is advice, go do this. These are things to be aware of and things to read through the 4 newsletters and listen to the 4-part podcast. Take all this in, go sit down with some professionals and go get some really detailed advice based on your circumstances.
Exactly. So the fourth one, so we've gone through kind of all these trade-offs, the taxes, the early X. So eventually startups get too big. Even options don't make sense because of the tax burdens and such, the cost to exercise and whatnot we're talking about. They'll switch over to what are called RSUs, restricted stock units. They are the most straightforward of the bunch. Again, it's 4-year vesting, 1-year cliff. Let's assume that's the structure. A restricted stock unit, you take ownership of the unit, not the underlying equity. You take ownership of the unit at vesting. It just follows your vesting schedule. You owe taxes when you receive it. But typically the company has the option of either delivering you the cash value or the actual equity. Now, why would a company do this? Well, typically they're going to do it when they expect to go public. So even though you vest it early, you don't owe taxes until they deliver you that cash or that equity. So if they say, hey, we think we're going to go public in 5 years, we're super valuable, we're worth $10 billion, so we don't want to hit you with the exercise cost, we don't want to hit you with the tax cost, here are your RSUs, your restricted stock units. You're going to earn them over the next 4 years. You come to the end of the 4 years, we'll ignore any re-upping of equity. You're now sitting on a bucket of equity that you're entitled to but don't own. And now you're just waiting on the company to go public. When it goes public, there's typically a trigger event in your RSU contract that says, when it goes public, the company owes you that bucket of equity or the cash equivalent. And that works because at that point in time, if they deliver you cash, you can go pay your taxes. If they deliver you the equity, you can sell the equity to pay the taxes. Oftentimes they'll deliver you a bundle of both. Here's equity and some cash. You can just dump the cash immediately to go pay the taxes.
And this is, as we talked about, there's these kind of stages of startups. This is your, and I'm massively generalizing here. This is startup aged 8 on a trajectory to get to start. My dogs come to say hello in the background, but this is your startup that's 8, 9, 10 years through its cycle and can see a path to getting to IPO. They would typically start to use RSUs there as a vehicle rather than other forms of giving you equity.
Correct. And the challenge with RSUs, and you hear it as I walk through it, you owe taxes on the full value of that equity the moment it's delivered to you. So as we go, the tax burden gets worse and worse through these structures. With RSAs, the value's super low. You immediately own the equity. Yeah, you owe taxes on all the whole value of the equity, but the equity is not worth anything. So the amount of taxes you owe is fairly trivial. Options, you only owe taxes on the difference between the strike price and the current value. But if you exercise soon, that's probably going to be fairly small. Whereas you get all the way to RSUs, you owe it on the entire value of the equity. And that, needless to say, it's ordinary income tax. It's going to be 35%. You're going to get slammed. Now, the flip side is, from a startup perspective, why do they do that? Well, because they can, in each scenario, we're putting off the when you're going to need to pay those taxes. With RSAs, the employee has to pay it immediately. Yeah, it's small, but you're fully burdening them with it today. The options, they get to put it off until they exercise. It's going to be bad when they exercise, but they have flexibility. RSUs, you're going to own it the moment you get delivered the equity, but the startup can put off delivering that equity as long as they want, typically until IPO, when they know you can afford it.
So I think there's some good things here, as we talked about, different timelines, different things to be aware of. How would you wrap this up for us, Jared?
I'd come back to the start, which is, if you're thinking about joining a company, first off, go think through the structure of the equity, go look into it, understand what the time horizon is for the company to go public, understand what your liquidity options are today. If you can find out what the preference stack is among the investors, go figure it out. But you need to take these things into consideration, because not all equity is made equal. Depending on what type you're getting, how it's structured, the timeline, they can be worth wildly different things. Second thing is, understand that it is a lottery ticket. And that cuts both ways. It can provide tremendous upside, but if you get to a point in the startup's life where the startup's not doing so well, you need to assume that the lottery ticket's probably not worth that much anymore. You're at the bottom of the preference stack. It's something that maybe is worth a lot. You may be better off thinking about joining another company. Again, if you're taking a low salary and you get a lottery ticket and you find out the lottery ticket's not worth a lot, you probably should reevaluate where you're spending your time and what the value is of what you're earning out. Third thing, this is 4D chess. There's a huge number of moving parts. Highly, highly recommend talking with someone, whether that's professional, accountant, tax advisor, the like, or talking with folks in your network that have been through the startup ringer before and have deep thoughts on this. Certainly more than welcome to engage me, the letter, my email, and Kleebeard on Twitter. Be happy to talk with you about this kind of in, we'll call off the record type way, and give friendly advice. But this stuff is really difficult, and it's worth engaging with, because again, if you're at a startup, you're there in expectation because you think it's going to be world changing. It's going to be worth a lot of money. This is the biggest single component of your compensation. This in expectation is going to be the biggest component making up your net worth in the future. It's worth spending the time to understand it.
And I think that's a fantastic summary there. Lots to unpack. Highly recommend you go and listen to the subsequent episodes that we recorded before this. Yes, it's starting to become like Star Wars. There's some prequels. There's going to be things coming in. I can't guarantee this won't be the last time we cover this subject.
We will promise that there will be no Jar Jar Binks making its way into our podcast here.
Don't get me started. I think that's a great way for us to wrap. You've been listening to the Fat Tailed Thoughts podcast, brought to you by Jared and Stephen here as always. Please click and subscribe. Tell your friends about us. Engage with us on YouTube. Engage with us on Twitter. Like and subscribe on our various podcast broadcast channels. You've been listening to the Fat Tailed Thoughts podcast. We'll see you next week. Thanks so much for listening.